As the summer winds down, I want to share with you what we think really moves the markets over the long term. Let's get this out of the way for the month of August. The market's finished up again. But what I really want to talk to you about is why. What really moves the markets? And what I want you to understand is there's really two very different things that move the markets. The things that most people worry about are the day-to-day things that move the markets. And these are the traders, and they're getting in and out and they're betting direction and all this other stuff. And the vast majority of what we do here has absolutely nothing to do with that. A long-term investor is not a gambler, is not a speculator. And that the day traders and these institutions that are playing games and all the financial information that you watch on the TV of up, down, sideways, get in, get out, mad money, isn't what we do here. What we do here is we do fundamentals. And what most people don't realize is what continues to drive markets up over time is something called earnings, which is actually profits of the companies. And why markets continually go higher is because companies come out, they report their earnings. The vast majority of companies beat expectations on a consistent basis. And then they tell us what they think what's going to happen in the next couple of quarters. And they usually project out a year. And so what continues to drive markets to go higher is the companies themselves are telling us they expect to make more money in the next couple of quarters or over the next year, more profits. And if the company's more profitable, it's worth more. And that's what the fundamentals are that we pay attention to when we're managing portfolios. And so, though there's all this uncertainty, what we're finding as a trend here as we end August is companies are coming back after the uncertainty of tariffs that are starting to play themselves out, after the tax code changes. They're coming out and now they're starting to increase the earnings expectations, meaning they're telling us now in August that they're expected to make more than they expected to make back in March or back in January or back in the past. They're increasing their expectations. And if you're going to increase the expectations of enough companies, the markets are going to move higher based on that increase. And those are fundamentals that we pay attention to so we don't have to overreact to the day-to-day uncertainties. We pay attention to what are the companies telling us is going to happen. So what do you need to do? One, you need to know as a client, we're worrying about this for you. We are monitoring this for you. What you need to do is make sure that we have up-to-date understandings of what you need over the next 12 months. What funds do you need to make sure you can enjoy the life that you have? Or what are the funds that are extra that we need to invest to make sure you can have that life that you want to have in the future? And if you're listening to this and you're not a client and you're dealing with an advisor that wants to keep showing you pie charts or keep talking about why you should get in and out of things, you might be better with a different advisor having a conversation about what's important to you and knowing that they're taking care of the portfolios based on some fundamentals that actually don't change that often. And what the fundamentals show over time is things are often better today than we realize.